welcome. It was the final trading week of 2025, and while activity, is typically subdued, at this time of the year, Nigeria's economic story remains anything but quiet. As businesses wind down for the holidays, attention stays firmly on policy direction, from monetary conditions and exchange rate management to fiscal discipline and revenue mobilization, all against the backdrop of reducing inflation pressures, according to the data, and fragile consumer confidence. I'm Ladi Williams. This is Business Morning. Let's get to the top stories now. We're seeing all markets walking a geopolitical tightrope this Monday morning after a 2% slide on Friday. Crude is bouncing back, as the world, watches what's playing out there with geopolitics. $61.27 a barrel. That's for Brent crude, 1.04%. This is like deja vu at this point. Starts the week normally strong, like this. 1.02% jump for WTI crude, $57.32 a barrel. The question is, will this continue this week? But that's the picture right there in the oil market. All right, to other matters now. I will see Nigeria's fiscal position is back in focus after the federal government approved a write-off of the significant debt owed by the Nigerian National Petroleum Company Limited to the Federation account. President Bola Tinubu has authorized the cancellation of about $1.42 billion and 5.57 trillion naira following a reconciliation of records between NNPC Limited and the government. The approval is contained in a document prepared by the Nigerian Upstream and Petroleum Regulatory Commission and presented at the November FAC meeting. The report shows the obligations previously reported in October 2025 have now been nulled off as December 31st, 2024, based on recommendations from a stakeholder reconciliation committee. The move raises fresh questions about fiscal transparency, all revenue accounting, and the implications for federal and state allocations going forward. So other matters now, we see the Securities and Exchange Commission. I see that Nigeria's capital market continues to show resilience, with firms raising over $753 billion through commercial paper issuances within just 5 months. The Director General of the Securities and Exchange Commission, Dr. Omomotimi Agama, says the funds were raised between April and October 2025, reflecting strong investor confidence and robust demand for short-term financing across key sectors, including manufacturing, energy, and agriculture. He also highlighted landmark debt transactions such as this 500 billion naira climate fund SPV and a 200 billion naira electron finance bond, pointing growing appetite for infrastructure and sustainable finance investments. According to the SEC, the figures underline confidence in Nigeria's regulatory framework and capital market architecture. I'll see the federal government have generated over 8.09 trillion naira from value-added tax and electronic money transfer levies in the first 11 months of 2025. Figures from the Federation Account Allocation Committee, that's FAC, showed that 7.69 trillion naira came from VAT, while 403.68 billion was collected through the electronic money transfer levy between January and November. The data reveals fluctuating monthly VAT collections with a peak in September before declining in October and November, reflecting changing consumption and transaction patterns across the economy. The revenue performance highlights the growing importance of consumption taxes and digital transactions in supporting government finances amid ongoing fiscal pressures at this time. Let's look at forecasts now. Is Nigeria finally moving from sharp pain of structural reforms to the steady gain of economic growth? Well, the Center for the Promotion of Private Enterprise is betting on a major comeback. In its 2026 outlook, the CPPE projects a robust 4.5% GDP expansion, fueled by a Naira that has finally found its footing within the 1.4 to 1.5 band. Dr. Muda Yusuf labels 2025 the definitive turning point, the year where stabilization finally took root, easing imported inflation and restoring much-needed predictability to investment planning and business confidence, and definitely be getting more forecasts at this point for Nigeria's economy. All right, to other company matters now. President of Dangote Group, Alhaji Aliko Dangote, has emphasized that empowering Africa to feed, power, and industrialize itself is a key driver of the Dangote Group during the unveiling of the Dangote Vision 2030 in Lagos. The event, attended by the Vice President industry leaders, governors, and other notable figures outlined the group's roadmap to achieving a $100 billion valuation by 2030. We'll get to that report now, but for our DSTV viewers, we'll be joining a media chat now with the Minister of the FCT. That's for the end of year media chat, but you can follow the money right here on other platforms. Right, let's get a check now on the vision for the Dangote Group.
As disclosed in this hall in Lagos, in just 5 years, Dangote Group looks to turn a $30 billion conglomerate into a $100 billion empire.
We invite you to walk this journey with us.
Its president, Alhaji Aliko Dangote, addresses how to supercharge Dangote Group for long-term success.
Next phase requires partners who believe in Africa's long-term potential. I actually just came back from the Middle East yesterday, yesterday. And we have had a lot of interest where people want to come and invest, but they don't have partners. And we told them that, look, we are ready to partner. The thinking of Dangote before, where we want to own the business 100%, has now changed. We can go as low as 51%.
As the Vice President Kashim Shettima and top functionaries in the public and private sector pay attention, financing the next phase is an integral component, taking into account Dangote Refinery, fertilizer, cement, and Dangote Foods.
It's my task today to reaffirm how we're going to go to this journey. Dangote Group itself, the journey has multiple of pillars. Starting from Africa first is the motto. This is our purpose. And industrial power. We have the global ambition and the African scale, which supports with the transformation. I just like to put a diagram for you to visualize what really it entails 100 billion turnover. We need to understand this is a very critical point of the milestone that we're at the crossroad. I'm just putting an illustration what 100 billion revenues is going to be on the scale. You are looking for the other global companies itself. This is global Fortune 100 companies. There are only 49 of them still on this scale. We are committed to be Dangote, moving to this journey to advance the global 100. And that's gonna be the leading Africa into the world league.
A countdown ensues with the leaders in the public and private sector on hand, side by side.
3, 2, 1, and push. Thank you.
Alhaji Aliko Dangote's altruism is not just national, but international, accelerating Africa's industrial revolution with Dangote Group's Vision 2030.
All right, now to our first conversation. Nigeria's manufacturing sector is navigating one of its most delicate transitions in years. Caution caught between, emerging macroeconomic stability and, stubborn structural constraints. While inflation is beginning to ease and exchange rate pressures show signs of moderation. Let's find out how, the factories across the country are faring. Joining us for this conversation now, Mr. George Onofowoko, is the MD CEO, Coleman Wires and Cables, joining me right here in the studios. Great to have you, sir.
Good to be here, Landy.
Yes, fantastic being here. The end of 2025. It's been quite the year. And I'm trying to imagine 2024 when we're coming into 2025. Looking at all that's played out, so far, how would you rate both years?
2024 was a really difficult year for most manufacturers when you look at it. Because we came out from 2023 elections with a lot of what we call ad blows, but definite ad blows that were necessary in terms of the petrol subsidy removal, harmonization of the FX windows into one, and that impacted massively inflation. It basically also turned into a massive loss by 2024. Exchange rate losses massively impacting the bottom lines of most of the manufacturers by the time you looked at their end-of-year figures for 2024. But be it may, we've moved away from that now, and I think 2025 literally meant most of those macro policies of the government itself, especially the central bank, seem to have done something right between 2024 and now. Inflation went up as high as 35%. You had the rebasing that also brought it down to about 25% from 35. And now we're looking at inflation now down to 14.45%. And
I wonder if anybody saw that coming.
14. Really, 14. Really, I think we all did, because for me, I did. And I took a position that, look, it was going to happen. It was consequences of certain macro policies that were difficult, but they were steady. And they were, I'll say the CBN was stricter on the policies, and people actually could understand the policies this time. And there was no deviation on policy. No favoritism on policy. I'll say that's the real direction. And that helped. Eventually, speculation on the FX scenario, nobody's speculating. If you speculate on FX today, you're looking for trouble. The window.
I remember you said that. Was it 2024?
Yeah.
You did say that. You said, don't bet against the Naira. That was the exact word.
And it happened. Because, look, what for me I looked at is that who was actually heading the CBN? And for the short period of time he had been there, you actually looked at, we were having a CBN that was more interested in the long-term macro policy than short-term gains only. And two, you literally looked at the scenario. Let me not hit the nail in the head. The corruption factor, really, the systemic issues we had that had influenced macro policies, really we were coming out of it. And kudos to the CBN Governor Cardoso and his team, really. For me, I can't believe that in 2 years we have a very stable macro policy, and the situation has enabled businesses to be able to predict a lot better. And the stability of 2025, I'll say, has given a bit more confidence to the market. And you can see in the figures, you can see the stability, you can see even in the growth. When you look at the figures that will come out of even any of the sectors, in terms of their bottom line PAT, BPTs, that you'll be seeing at the end of this year, and we'll be looking at the figures, most likely you'll start seeing by first quarter of next year, figures coming out from every sector of Nigeria. They'll all be more positive. And we have gone through that recovery, and now we're going to a growth stage. That, to me, is where I see it going.
Fantastic. Well, looking at the macroeconomic indicators, for 2025, which ones give you confidence, at this point, and which one is still giving you worry?
I think today, if we have to look at it, the biggest confidence we have on the macro policy is the FX-related policy. It's very stable. The stability of the FX, now it's almost predictable. We're between 1.4 and 1.5. And it's predicted. We would appreciate, but I think the CBN literally is trying to control things so that we don't literally get into another scenario where an appreciating currency becomes a negative position because we go into an import-dependent scenario. And so I see the stability of the 1.4 scenario to the 1.5 scenario over the course of 2026. Now, so that gives me the real concern still is bordering on the interest rate factors and some areas that are, if you look at the interest rate MPR today is at 27%. I do not expect, and this is where the worry comes from the manufacturer's point of view, we do not expect a fast-paced reduction in MPR. It's not going to happen because you have to balance inflation, balance FX to actually, so yes, most likely a 3 to 4% reduction over the course of 2026 is the expectation. So we're getting an NPR at about 23, 24 towards the end of the year. Take the discount factor. But the good thing about it is that no matter how you see it, interest rate will go down. Now, would it get to the rate at which we want immediately? Of course not. But we will see some incentive or buzz that is happening in terms of spending dynamics, which should cushion some of the situation that I'll look at it. In terms of, look, spending power would improve. You have a stable currency, and you have to remember that if we look at our 2024, when I was saying, oh, the Naira, at the beginning of the year. The reality is today, for those of us that have held the Naira, you've had an appreciated Naira, which means your worth in Naira has increased in value, which also means that simultaneously people's buying power has also improved in value. So if you have had a pay rise in 2024, and a lot of people between 2023 and 2024 got a massive pay rise to cushion inflation, cushion the impact of all the negative that came out of harmonization, removal of subsidy, but I can't reverse your salary, can I?
No.
So the good thing also is an appreciated currency, a stable currency, inflation going down automatically means your purchasing power has improved. Take, for instance, especially in agriculture.
But some other, wage earners complain that wages have not risen as much as inflation and the currency devaluation. If depending on where you're coming from, at this point, it's still sticky.
The reality is wage should never match inflation, because if you're managing inflation, the expectation is over time, inflation should come down. It's only wage should actually rise, or most likely above inflation. If you're dealing with an hyperinflation scenario where literally we have a runaway inflation, we didn't have that. So if you took wage above the limit, what will happen to us is what happened to the textile industry. What killed the textile industry? Wages ran above their ability for them to reverse it. And by the time, and what created that? The textile industry in the 80s were giving cheap licenses that enabled them to actually buy dollars on the cheap, and they were making crazy money on import license. The import license made more money than they actually did producing in textile. Now, the problem happened is that they were declaring a lot of profits, especially those that were public quoted. And they were increasing wages at over 100, 200% because they felt they were making money. The reality set in when you actually made import license to everybody, it made it equal. So there was no exceptional gains anymore. You can't reverse. When you're looking at an inflation figure, you cannot compare it to a stable scenario. Wages should go up, but should moderate and then stay in line with inflation. If we go too high, what will happen with most businesses, let be sincere, they take wages so high up, and you find out when things stabilize, they can't reverse it, then they can't sustain the repayments or the payables that they have. And you end up in another crisis where businesses shutting down because they can't sustain their workforce. What we have to be very careful is I think as Nigerians, is that we shouldn't go sentimental over what short-term gains will give us and leave the long term. For a manufacturer to sustain a business today, you have to think of the long goal. You cannot be thinking of just today. Because your manufacturing plant doesn't shut down, your equipment is not a one-year equipment. It's a lifetime equipment. So you have to look at the sustainability of your growth and of your scenarios. I think the biggest impact for next year for it to work would be us merging a bit of the inconsistent fiscal policies with the consistent macro policies. Now, I think that would be the biggest game changer for 2026. Yes, we have a risk factor of we moving it closer into an election year of 2027. That's still an underlying risk, the security risk. Quite a few factors are still there in terms of risk analysis. But leave the risk analysis a little bit down and look at what will balance growth. And to me, some of the fiscal policies are now necessary, Because look, we cannot reverse interest rate into zero overnight. So what are the incentives to actually get us there? One of the key things, and I think is one of the gas policies in Nigeria now, this is the time for the government to take the bull by the horn. Yes, you wiped off a lot of things, but the reality is the manufacturers today, 99% of them are the one literally having their own independent power source, whether diesel, but majority have now moved to gas. The gas inconsistency on policies for a few against the many doesn't make sense to me, sincerely. And I have to be frank with the government. It is not sensible for a few to have subsidized gas pricing, while the majority that have also invested in the gas are paying $8. It doesn't make sense. Now, I think even MAN proposed to the government that, look, this was more than almost a decade, 8 years ago, that we should get gas to at least $4 to $5, including the transport
Because
cost.
in the global market, I think it's around $2 to $3.
It doesn't make sense to me that Nigeria wants investment in industry, but is making the power cost not as cost effective as the gas we sell to others. So if I'm selling gas as a country to a third-party country, China, and they're selling $4 or $3.80, and I'm selling gas in Nigeria at $8 to where the source is, it does not make sense.
So this reminds me of what Mr. Dangote said, recently about, cement prices here in the country. He said it's more expensive here.
Correct.
Because of a number of factors. But when you sell it, when you export, he's able to sell cheaper in other markets.
Correct.
And I know you also sell in other markets. Is that the same story?
It is. But our own story is even worse. We are not being able to be competitive outside the market as we should be. Because unlike cement, where 95% of source of raw materials is local, 95% of source of cable is not local. So that also impacts. You have an import element. And when your import element in Nigeria is not zero, unless you're in a free trade zone, and that changes the dynamics. Now, we hope that we see ourselves as a processing country. Yes, we have free trade zone policies, but it needs to be better harmonized also, and also for those that need it, they need to have it. The major difference on the tax policy now for the free trade zone is now they're taxable, which means their incomes are taxable. The imports and exports are not, but their incomes are. For me, I have no problem with that. I know some people will say that's very controversial, but even if I'm applying, you should pay taxes. Now, we have no issue with that. I don't think any manufacturer, even MAN, has an issue with the tax policies. What we keep saying is that whatever we do...
So you're not as nervous as everyone else for January 1st?
I don't think we should. I think the nervousness will be for those that don't pay it. For me, I paid my taxes, and for me, I pay my company taxes, and I pay a lot of it. And we are disadvantaged when people don't pay. We're seeing scenarios of companies that don't pay look as if they're more competitive, but those that pay are penalized for actually paying because they're focused on. And the ones that don't pay are not really as focused on. But the policy changes a lot of things. It's bringing those that don't pay in. If you look at it, majority of the people complaining, I think, are more of those that don't pay. The people that pay are quiet because there's a benefit. Your company income tax reduces in year one. So we're going from a 30% tax to a 25% tax. Now, a lot of things changes maybe to the benefit of those paying. And if you look at it, for the small businesses, there's a lot of waivers, and I think Nigeria finally woke up that, which happens even in the UK. Your first 80 to 90,000 pounds of sale is not vatable. You should not declare VAT. You are not a VAT client to the HMRC. Same thing here now. It's saying 100 million naira worth of, you are not taxable in terms of what you pay in terms of company income tax is gone. So there's a lot of things that would enable this country grow the right way and would actually now bring in the right people into the tax net. The reality is that a lot of companies And a lot of businesses are not in the taxes. I've seen places where someone believes the levy is paying in the market is the taxes to the government. The levy. And I asked that person just years ago, when the first time that person got called in by the tax office, he said he believed what he's been paying all his life in the levy. I said, how much is the levy? I think about 50,000 a year for the trader. And he felt that was the taxes. I said, and you sent your child to school in Nigeria, to the public school. You actually benefited from the same universities that are public related, but you paid 50,000 and you're almost 60. And so why? There's certain things we have to look at, that those that are paying.
So I guess education,
we need to. I think
a big role.
the government needs to play more role in educating everybody about the tax policy. By coincidence, I met Taiwo Dele by coincidence at the airport, and we spoke about it. And I said, certain things you just have to let people know more about, because they're scared about their investment, they're scared about their savings, they're scared about the taxes. And, the real fact is, if me and you put our money in the bank, and we get interest, and they take withholding tax, that's the end of tax. But a lot of people don't know that. They believe that, okay, the interest again that they've earned is tax again. That's double taxation. So there's a one-off withholding tax that goes off your interest that you have paid immediately at 10% withholding. That's end of it. Nobody in the world, in Nigeria today, can actually hold you or me for tax again once that interest withholding tax is taken. So that's your income. So what you're paying taxes on is separate to non-withholding tax issues. So we must have a better understanding of the impact of the taxes to the businesses. But the greatest element of what we need to do, and I still want to focus on that, is that the fiscal policies that we must enable industry in 2026. Because when you look at even our GDP figures, we're still fluctuating on manufacturing. Agriculture has helped. Fantastic. Yeah, today, a lot of things in agriculture, cost has come down, Gary has come down because cassava became literally it. We were flooded this year season with cassava. And so a lot of things have come down in price because the weather was right, the rain, the production was right, the yield was right, and helped in the inflationary figures, and also helped in our GDP figures. But how do we keep manufacturing figures not fluctuating? We cannot survive this country without manufacturing. We cannot survive this country without processing. So certain things, we just must make sure fiscal policy must balance micro policy. It doesn't matter if I have the cheapest interest rate. It doesn't matter if I have a stable currency. If I cannot produce cost effectively, it's still a problem. And that is the part that the government needs to actually put a lot of. And the good thing is, if we look at the ministers we have today, they're more technocrats than politicians. And that is helping in industry today and in industry, trade, and investment. We have two ministers that literally understand what the onion is, especially the substantive minister. So we got the people with the right onions. We got in communications, we got in finance, and so many ministries are filled with people that are capable. What we just need them now to do is that, look, please, can you just sit down, put a think tank together, and look at impact analysis, quick wins. I think first quick wins is get the gas policy right. Second quick win will be also look at the monetary tariff, the tariff measuring policy, which has not been signed off since 2023. We keep getting it moved, 2024, 2025, because that's where the tariff guidelines are moved up or down in order to protect some industry, in order to ease other industry. And that has not been signed off. And we've told again, it will be signed off in 2026. When? Now, we've lost 3 years for a manufacturing sector to be incentivized by that or be protected by that. So the impact is negative, straight off. So if they don't sign it off again in 2026, January, I don't see how they want to have a consistent 4.5. Everybody's looking from a 4 to a 4.5 by the end of 2026. if manufacturing still continue to flutter on those figures, we're going to struggle again.
All right, so get that, gas policy right for 2026. Then we can see, manufacturing actually, gain more grounds when it comes to contribution to the GDP. All right, definitely we've seen a lot of milestones from Coleman Wires and Cables in 2025. What are we seeing in 2026?
For us, I think we're still seeing a lot of opportunities. I think we've been always positively thinking of the economy. We see opportunities in different sectors, telecom sector, oil and gas with a lot of FIDs coming up. And we see the export market, really. And I think that's going to be the game changer for us, the export market. It's not really the Nigerian market. Nigerian market, I think we're going to get that right between 2026 policies coming out the way with it. But I think for us as Coleman, I think really is to see that the infrastructural spend that we expect to actually be a boom year in 2026 to 2027 is to actually see the expenditure going local and to also see the policy encouraging the export. Because if today you've got a business that can satisfy 50% of Africa from one location, I don't see why you should not enable it. And that to me, I think, and sincerely, we've seen a lot more listening ears from the government than we used to see. And that to me is going to be our game changer. So the export market is the future market in terms of Coleman. The Nigerian market, of course, we're very happy.
Let's not abandon the Nigerian market.
We can't abandon the Nigerian market ever.
Fantastic.
So seasoned greetings to everybody anyway, channels and the whole of Nigeria and to all our clients. And I think for us, really, we've been thankful for 2025, 50 years of the business, and we still look forward to the next 50 years.
Fantastic. Thank you so much, Mr. George Onofo, as the MD CEO, Coleman Wires and Cables. I guess at this point, I'll see you in 2026.
Definitely, yeah.
Fantastic. Thank you for coming, sir.
Take care.
All right, we'll take a break now. When we come back, we'll find out what to expect also for Nigeria's stock market and other variables. That's in a moment. Just stay with us. See, 2025, the year Nigerian exchange surged by about 50%, and inflation finally dipped below the 15% mark. The big question, can we sustain the momentum? But as we celebrate, the geopolitical landscape has shifted on their feet following the Christmas Day U.S. airstrikes against ISIS-linked groups in Sokoto. Well, today we'll break down the charts, the security alerts, and your wallet's outlook for 2026. Join us for this conversation. We have Ugo Dre Obichukwu, founder, CEO, Nairametrics, joining me via Zoom. Great to have you on the show, sir. Good morning.
Always a pleasure, man. How are you? Compliments of the season.
Compliments of the season. Yeah, so, definitely, I guess the stock market has given us, or given most investors a reason to smile this year. We've seen largely driven by the consumer goods and, banking counter. And we've seen some stocks really do well, in 2025. So what are you seeing, going forward? Are we seeing a bubble or a fundamental shift in value here?
Why are you being pessimistic? Why do you think it's a bubble?
I know, it's the bear in me.
All right. I mean, it's been a great year for the stock market, despite all the challenges that we've seen at the later part of the year. I think the stock market is up 49% year to date. Very likely to close borderline 48, 49%. I'll be surprised if it does hit 50. However, total market cap, which I personally hoped we hit 100 trillion. We're currently at 97 trillion. I don't know how we hit 100 trillion over the next 3 days, but you know what? Anything is possible. So yes, it's been a great year for the market. Some of the positives is that it's been local investors, institutional investors that have basically been driving the market forward. You've seen a lot of investment come in from both institutional and retail investors. There's a lot of capital that has been raised this year. whether it's even through public offers, right issues. You've even seen a lot of debt-related capital being raised as well. Commercial papers, according to SEC, hit over 700 billion between April and October this year. You've seen also a lot of government debt issuances, all successful and all largely oversubscribed. So it's been a bumper year for capital market operators. I'm sure that a lot of them are going to be declaring massive profits. For investors as well, who have very well positioned portfolio, also been a very good year with the market up 49%. So we look forward to 2026, Ladi, more optimistic, not as pessimistic as you.
All right, I guess the Bears can, take a seat, at this point. But, we've seen other asset classes do really well. In 2025, we've seen the likes of gold. Gold is just, ripping new highs and, most of the metals at this point. And we're seeing that happen with, risk assets also rising, except for, maybe Bitcoin. What do you think the market is really trying to tell us here? Seeing gold, rising, risk assets also rising.
I mean, that's the global discussion, and if you look at some of the data and some of the analyst reviews that we've seen, it would appear that commodity prices are also going up, particularly for precious metals, largely because of a lot of global investors, institutional and wealth funds. Essentially trying to, maybe decouple from U.S. assets. So you've seen people essentially spreading their investments apart from just holding, U.S. assets. They are also holding, precious metals like gold, silver, and even, Bitcoin. Despite the pullback that we've seen recently, Bitcoin is still almost at year highs, multi-year highs. So that is what is essentially happening, Ladi. So people are a little bit worried about what's happening in the U.S. The U.S. debt is at an all-time high. The political gridlock in the U.S., the tariff issue was also a major concern. So you're seeing a lot of countries or a lot of businesses or investors that typically would hold large part of their portfolio in U.S. debt also now, essentially diversifying, and gold appears to be one of those assets that have gained largely for this, even silver as well. And that's what's going on. And you're also seeing not just that, you're also seeing global markets also at multi-year highs as well, whether it's the US market or the EU market, just as we're seeing record numbers in Nigeria, you're also seeing record numbers in some emerging markets and in some well-developed market as well. So it kind of appears that there's a lot of capital globally flowing. Let's remember that some of the capital surge that we saw because of COVID-19, QE, as some would like to call it, a lot of the money that was printed globally, a lot of that money is still floating around, and so that is also driving asset prices forward. Interest rates are also expected to come down, at least from the US point of view, the end of this year. That would also continue to drive capital flows into various assets. So it kind of looks like, bearing any major insecurity issues globally, asset prices all seem primed to keep going up. Now, let's also, bear in mind that there were fears that we could be heading towards some kind of global recession, particularly with some of the decisions of the U.S. From the tariff increase, from the global tariff war, as some would call it. But that hasn't really panned out at the moment, because it kind of seems like when that threat sort of comes up, then the politicians find a way of sort of dialing back. And so investors seem to have studied how these things have panned out. I've seen that, look, there's a lot at stake, and global world leaders are not ready to throw the entire kitchen sink out. So they are also a little bit coy, as much as they sound like they're trying to disrupt the global world order. So what you're seeing is a lot of reordering. You're seeing investors smarter with how they're pushing their money around. Investment flow is still happening. It is unlikely that you're going to see a pushback, at least early next year. Perhaps maybe as we approach the midterms, you see how politicians play and how things happen. When I mean midterms in the US. But for now, Ladi, it looks like the bulls are at least over the next 3, if not 6 months.
All right, and talking about the U.S. At this point, you did mention the U.S. Fed, cutting rates. Let's bring it out to what's played out, right here in Nigeria. How significant is the reported, U.S. strike on ISIS-linked targets, in Nigeria, from an investment and market risk perspective, in your opinion?
I mean, from an investment and market risk perspective, I really don't see any negative impact. Like I said, I think investors have found a way to sort of, explain some of these things out. They don't see it as existential to their investments. Let's bear in mind that, this happened in the Northwest, not in where we would consider economic zones for foreign investors, like maybe Lagos or even Abuja or even Port Harcourt. So for a lot of investors, they are still locked in. I don't think, and from the feedback that we've gotten from some of them, they are overtly worried. Let's bear in mind that Trump had started warning the government as far back as early November that this could happen, and then this eventually happened. And it also, as much as it was shocking that this is basically the first time that Nigeria, you've seen missiles hit from the U.S. and that it's never happened before. Investors, I think, kind of look at it from a different angle, and you can see that from the way asset prices have surged over the last week or so. Even when this attack did even happen, markets are open now. I suspect markets are probably going to open positive, so I don't see any negative impact here, Ladi. And bear in mind that Nigerian market, local market, when I mean market, of course, we mean equities and debt market, have largely been driven by locals and not, and not institutional or foreign investors. We do see foreign investment participation, but not at the level to negatively impact market growth here. But security remains an issue, remains something that investors are watching ahead of 2026. But for now, it appears the reaction is largely muted.
Yeah, it was quite interesting, watching international media actually reporting what played out in the oil market and relating it to what's playing out in Venezuela and the strikes in Nigeria. That was most of the news, last year. It was quite interesting, seeing that. But does this incident materially affect, Nigeria's, sovereign risk profile, or credit outlook?
Well, I don't think it does. There were concerns at some point in the last couple of weeks that we could see a reduction in our credit rating, largely due to some of the insecurity that we've been seeing, not necessarily because of the strikes that we just witnessed, but because of the plethora of insecurity issues that has been gathering over the last weeks or so. That was our expectation, and that is still likely possible. Ladi, let's not rule that out. And we all know the impact of this. If this does happen, it means that Nigeria's ability to borrow is going to be a lot more expensive. Not that we still can borrow, but we're likely going to be paying a lot more in interest rates. So that is a huge concern. And if there's any downer in all of this, I kind of think that is the downer from an economic and financial point of view, and that rating agencies could also, look at Nigeria's credit rating and downgrade it based on it. But larger than that, Ladi, I think the bigger problem is even Nigeria's looming fiscal deficit. I think we saw the MTF numbers recently, and that was very, very disturbing. When you're seeing, as of July, government oil revenue down 70-something%, actual versus budget. So that was essentially an eye-opener and a shocker to a lot of people. So this is not even about oil prices and crude oil production, which obviously it appears our assumptions were highly overstated in the 2025 budget, and this is also something a lot of people had raised when this budget was pushed out. So, but the fact that we're seeing deficit widening for an already record fiscal deficit budget is a huge issue, and this is where you kind of think rating agencies will be looking closely at Nigeria's ability to continue to be physically at least compliant in a way, being able to drive down deficit while still increasing capital expenditure. And so, of course, you also know capital expenditures was way, way, way below budget. And with capital expenditure below budget, I am personally worried that we would see the sort of growth that a lot of us are anticipating in 2026. To be honest, if we touch 5% GDP growth rate next year, it would be a miracle, a huge, huge miracle.
I guess the government needs to get creative with revenue generation at this point, seeing the disparity there. But let's look at monetary policy now. Central Bank maintained a tight monetary stance in most of 2025. Do you think the NPC, Central Bank, they achieved their core objectives this year?
Yeah, I mean, the core objective was to keep, in monetary policy hawkish while also, stabilizing the exchange rate and also seeing inflation numbers go down. And I think to that extent, you would say that the central bank has basically achieved all of its goals this year. And let's bear in mind that this is also happening in the middle of a major capital raise from banks. The central bank has also had a whole lot of reforms from the FX side, from the monetary policy side, from the financial stability side. So a whole lot going on. And I mean, if there was one government agency that you would want to give this plaudits, it obviously has to be the central bank because they've got a lot they've done this year, achieved in terms of achievement. At 27%, yes, a lot of us expected rates to be cut. I did expect it to be cut at the last NPC meeting in November. But it's understandable why they kept it hawkish. It's important to have full year data of the inflation numbers to see where inflation goes. A lot of us think inflation might pick up in December and January before it starts to taper down again due to base effects and of course significant spending in the Christmas based on 30 December. However, that interest rate had to be kept that way because the CBN still believes money supply is still very high. They still believe that structural issues are still affecting the ability for inflation numbers to go down further. Yes, we've seen inflation numbers go down way faster than we expect, but there's still a lot of challenges out there. There's still a lot of headwinds. Now, bear in mind that while they did not, reduce interest rates, NPR, they still cut the amount that they pay banks for taking money from banks to 22% as well. So that in a nutshell also suggests that while in the wider economy hasn't seen rates go down, rates have also gone down within the interbank framework of the CBN. Of course, standing facilities are now plus 50, minus 450 basis points. So that you would say, well, is some kind of cut. So largely it has helped, but manufacturers won't be happy with the way rates are. Interest rates are still pretty high at over 30%. But the benefit of that is you've seen a surge in commercial paper offerings. You've seen it in a surge in alternative, debt-related funding, which to a lot of banks should be a concern because then banks might have to play catch up by next year because a lot of the major lenders or the major borrowers, are now tapping into the debt markets, and a lot of them are tapping into this debt market successfully without having to give up collateral or a lot of the stringent requirements that banks should typically ask for. You would expect that next year when rates starts going down, banks would lend more, and maybe this might help the economy in general. But at the moment, the CBN has kept rates this high for obvious reasons. Next year, we do expect rates to come down. I do expect it when they meet in February. But of course, a lot of this will also depend on the data that the CBN is playing with by the end of January, Ladi.
All right, definitely hoping the banks, lend more in 2026. We did see the Securities and Exchange Commission there, mentioning the growth of commercial papers in 2025. Definitely we'll see who's able to lend more to most of the private sector. Thank you so much, Godre Mobichukwu, founder, CEO, Nairametrics. Thank you for coming on today, and I'll see you in 2026.
Always a pleasure, man. See you too.
All right, I'll take a break now. When we come back, we find out what's going on in the global economy. That's in a moment. Just stay with us. have any John McCraw with the details of what's playing out, even though it's a thin week.
Yeah, laddie.
You know, for most
the
of the
holiday
economy.
is in the air,
Right.
and it's global. So, I mean, a country like the United States, where you would have expectations for the week everywhere, the United Kingdom,
much more data
and all of that. I think
week.
those who have managed to stay active would be the Asian countries. Last week we saw a lot of information coming from China, Japan, Taiwan, Tokyo, and all of that. They are still the ones who are holding forth. But I mean, for our friends in the UK and the US,
not much.
On holiday.
They're relaxing. And
Exactly.
another data I'm very much interested in is how much weight you've been able to add with the festivities, you know, this period. I'm looking forward to that data. I guess we'll get that.
Laddie is about to reveal something about him. Let's keep our eyes or our ears close to
how
the
much
ground.
weight have you gained?
He's about to reveal
This
his weight
festivity.
on television after all the chicken and turkey he's eaten.
Yes.
Don't worry,
We'll get
waiting.
that data.
We're waiting for the number, Laddie.
Fantastic.
Exactly. Maybe you keep it for 31st, so we'll be able to have accumulation.
And compare it to 2024.
Exactly.
To see how well you fared. You know.
Good morning, everyone. Let's just tell you a little bit of what's going on in the global scene. We're starting from China, where seaborne imports of liquefied natural gas is expected to reach approximately 7.17 million tons this month, according to data from Kepler, which tracks shipping information. The figure represents a slight increase compared to the same period last year and marks the second consecutive month of year-on-year growth in LNG imports when measured against official Chinese data. The December import levels follow a surge in November, with Chinese buyers likely increasing their intake through long-term contracts rather than spot market purchases. Industry analyst notes that the Chinese firms are retaining more of their contracted supply as recent declines in spot energy prices have diminished the financial incentive to resell cargoes to other markets. Still in China, exported 199,836 EVs, electric vehicles in November. That shows an 87% increase year-on-year. That's China data from Chinese General Administration of Customs. The Asia imported highest number at 110,061 EVs, followed by Europe 42,927, Latin America and the Caribbean had 35,182. Mexico was the top single destination, and not, the regions. They received 19,344, and then a 2,367% increase from the previous year. That's Mexico there. Exports to the EU grew 39% year-on-year to 25,792 units. And then away from China, the yen recovered some ground this morning following a steep drop at the end of last week as markets weigh the timing of more interest rate hikes in Japan and the possibility of intervention in thin end-of-the-year trading. Bank of Japan policymakers debated the need to continue raising rates. A summary of opinions at their policy meeting in December shows that the euro, and we see that the euro was supported after U.S. President Donald Trump signals optimism in talks to reach a peace deal to end the war in Ukraine. Japan has a free hand in dealing with excessive moves in the yen, and the finance minister said that those intervention warnings have helped keep a lid on dollar-yen rates. And Russia, interesting country at this time, their manufacturing sector contracted at its fastest rate since March 2022 in December. This is according to data released by the S&P Global. The Purchasing Managers Index for Russian manufacturing fell 48.1 in December from 48.3 in November, and this marks the 7th consecutive month of contraction in the sector. A PMI reading we know below 50 indicates contraction, while reading above 50 signals growth.
All All right, Thank you so much for the details there, what's playing out. But that's the show today. Thank you for watching. We'll join you again at 1:30. We'll give you more updates on what's playing out with major markets that we track. I'm Ladi Williams from the team right here at Channels HQ. It's bye for now.